Oh, okay, class. Good afternoon. So you're welcome again to another class on strategic business reporting. Today, we are going to make progress. So in our last class, we covered or we finished IFRS 13 on fair value measurements, which is a standard that deals with how to determine fair value of assets and liability. And the high points from that standard that you need to hold and should always remember is the definition of fair value itself. So the definition of fair value says a lot about how fair value itself is determined, right? It says a lot about it. Then another one is, besides the definition, is the assumptions that are made by market participants from talking about determination of fair value in the principal and in the most advantageous markets to speaking about that fair value for a non-financial asset is its highest and best use and all of that. So these are key points from IFRS 13. Then before we then went to the valuation approaches, using a scientific approach to the determination of fair value, speaking of the income approach, the market approach, and the cost approach. And those valuation approaches takes us to the level of hierarchy from input 1, input 2, and input 3. You see, those are the key points from that IFRS 13 that you should always remember. Now, today, we are going to start and finish IAS 36, Impairment of Assets. Then on Wednesday, we'll be moving to IAS 12 on income tax. So, if you remember, we have discussed about impairment before. If you remember clearly, we discussed about impairment of financial assets, right? So here now, that means the first thing I quickly need to mention here is which asset are we talking about here, right? So the assets of focus in this standard are tangible and intangible assets. So basically, the asset of focus here will be the tangible assets regarding PPE and also intangible assets. That's with respect to IAS 38 on intangible assets. So IAS 36 is not going to cover impairment of financial assets. That has already been covered by IFRS 9. Okay. Additionally, impairment here is different from revaluation deficits. Impairment is different from revaluation deficits. See, this is because impairment is a permanent loss in the value of an asset. In the value of an asset is a permanent loss in the value of an asset. So when we say an asset is impaired, is very similar to saying an asset has been damaged, something like that. We are going to look at the the intricacies very soon. So, which is why I said that in terms of meaning, impairment is not the same as evaluation deficit, because evaluation deficit is a temporary fall in the value of an asset as a result of economic loss or economic gain. It could be because the economy is booming, you have a surplus, or because the economy is experiencing a downturn, you have a deficit. So that moves with economic happening and activities in that environment. But impairment is as a result of one event that happened, the asset was permanently lost. So you hardly hear of reversal of impairment. Not that it is impossible, but is rare. But it can actually happen. That's the first thing I needed or I need to clarify. The asset covered and the meaning of impairment. Now, the second thing I need to immediately clarify is the objective of this standard. What do you want to learn here in this standard? So what we want to learn here is to ensure that an asset is not carried at an amount to ensure that an asset is not carried at an amount that is higher than its realistic value. Is to ensure that an asset is not carried at an amount that is higher than its realistic value. That is one of the key objectives of what we want to look at today. To ensure that whenever you have an asset, it is not carried at an amount that is higher than its realistic value. So this standard will ensure that never happens. And secondly is that to prescribe an asset as impaired when it is carried at an amount that is higher than its realistic value. So whenever it happens that an asset is carried at an amount that is higher than its realistic value, immediately we say the asset is impaired. You prescribe the asset as impaired. Now, from this objective, there are a few things I feel we need to clarify. So that takes me to definitions of terms. And the very first is impairment loss. Impairment loss. So by definition, this is the amount by which the carrying amount of an asset is higher than its recoverable amount. So the impairment loss is the amount by which the carrying amount of an asset is higher than its recoverable amount. Almost everybody should know that the carrying amount, that this is the cost or fair value of an asset minus accumulated depreciation minus accumulated impairment losses. So, which is the book value of your assets, which is like the amount at which you recognize an asset in your books. The cost or fair value of an asset minus accumulated depreciation minus accumulated impairment losses. I also mentioned recoverable amounts. Okay, I'm back. Now, in the definition of impairment, it also mentioned recoverable amount. And this is the higher between the net realizable value of an asset, between net realizable value of an asset and its value in use. So look at the sequence of this presentation. I started with impairment loss. I said it's the amount by which the carrying amount of an asset is higher than its recoverable amount. Okay. We move to carrying amount. We said this is the cost of fair value of an asset minus accumulated depreciation minus accumulated impairment losses. You should all be familiar with carrying amount because that's the amount at which an asset is recognized in the books. Then recoverable amount. We said this is the higher between the net realizable value of an asset and its value in use. So this recoverable amount literally is the realistic value of an asset. So normally we don't expect that your carrying amount will be higher than its recoverable amount. It is synonymous to overvaluation of that asset when that happens. Your asset cannot be, the realistic value of your asset cannot be 10 naira. And you are carrying the asset in your books at 15 naira. That means you are not being true to yourself. And your books will not be faithfully represented. So, and that's where this standard comes in actually. So there are two terms here that we need to also clarify. One is net realizable value. This is the fair value or selling price of an asset minus the cost of disposal. This is the selling price or fair value of an asset minus cost of disposal. How much you can sell the asset. That's net realizable value. And we have value in use. This is the economic value of an asset and it is determined by ascertaining the present value of future cash flows that can be generated from the asset. So value in use is like, if I continue to use these assets, how much can I make from using these assets? So it's like the economic value of an asset. And the way you determine it is to get the present value of future cash flows that can be generated from that asset. That would give you your value in use. So these are all the relevant terminologies here. And from this definition, we should have a good understanding of what we want to look at in this standard. Number one is, I've told you, ensuring that the carrying amount is never higher than its realistic value. And you know, the carrying amount is the amount at which you recognize your assets in the books, while the realistic value is the recoverable amount, which is the higher between how much you can sell an asset, that is, its net realizable value, and if you don't wish to sell it, okay, how much can you make if you continue to use these assets over its useful life? How much will you make from these assets? So when you present value all the future cash flows from that asset, the accumulation of the present value is the value in use. Okay, not only that, these future cash flows will include the eventual disposal value of the asset. Okay, that okay, if I use it for 5 years and I sell it at scrap, okay, and I will sell it as scrap. How much can I sell it? Which is synonymous to its residual value. So you get the present value of all of that to get your value in use. Okay, now, having mentioned all of this, then the next thing that's important is, how would you even know that you are carrying your assets at an amount that is higher than its realistic value? How would you ever know that? Okay, and that takes us to indications, or let me call it indicators of impairments. These indicators of impairments is also called impairment review. We also call it impairment review. We have external indicators. And number one is when there is a fall in the market value of an asset. So if the market value of an asset falls, that's an indication that there might be a likely impairment, that you are overvaluing your asset. Number two is where there is a change in the economic, technological, and legal environment, in which the assets is located. So when there is a change in the economic, technological, and legal environment in which the assets is located, it might be an indication that you are overvaluing your assets, because a change in economic environment, a change in people's taste, a change in technology could mean that this asset might not be worth what you are carrying it at. A single government legislation can render the value of an asset useless. Another one is where there is an increase in interest rates that is used to determine the discount rate used to get the value in use. So when there is an increase in the interest rates that is used to determine the discount rate used to get value in use. So ordinarily, when you want to determine your value in use, you will need to discount future cash flows to present value. You will need to discount future cash flows to present value. And in doing that, you need a discount rate, right? And this discount rate, you get it by reference to either the MPR or yield on corporate bonds or risk-free rates, depends on the assets. But discount rate is determined by reference to this interest rate. So when interest rate increases, affecting the discount rates that you use, and because the higher the discount rates, the lower the value in use. The lower the value in use. So when your value in use is lower, it is an indication that you might be overvaluing your assets. It is an indication that the carrying amount might now be higher than it. So that is also an indicator of impairment. And finally is where the market capitalization of the entity is lower than its net assets. So when the market capitalization of the company, this will be applicable for a company that is listed. You looked at its market capitalization, that is their number of shares multiplied by their share price. You saw that this value is lower than the net assets of the company, meaning the total asset minus liabilities of that company. It could be an indication that this company is overvaluing its assets. Another one is the internal indicators. The internal indicators. And number one is where there is a physical damage of the assets. So a physical damage is also an indication of impairment when the asset is damaged. Number two, when there is a decline in the useful life of the assets, it is also an indication. Number three, when there is a decline in the productive performance of the assets, it is also an indication of impairment. So this is the first thing. This is what triggers impairment ordinarily. Without this, you can never even talk about impairment at all, indication of impairment. Now, having mentioned that, after impairment review has shown that there is an indicator or an indication that the asset is impaired, The next step is to determine the impairment loss by carrying out an impairment test. And impairment tests, or let me see, since I've mentioned impairment tests, let me say this involves determining the recoverable amount of the assets. So when you discover that there is an indication that this asset is impaired, then the next step immediately is to determine the impairment loss but by carrying out an impairment test. Okay, and this is where you determine the recoverable amounts that you then compare with the carrying amount. That you then compare with the carrying amount. Okay, that's impairment test. Now, this is what we are saying at a very simplistic level. So if you have a carrying amount of, let's say, 50 million, and we have, let's say, net realizable value of, let's say, 45 million, and we have value in use of, let's say, 48 million. In this case now, what's the recoverable amount? The recoverable amount is 48 million, being the higher between the net realizable value and the value in use. So an impairment loss is 2 million, being the difference between the carrying amount and the recoverable amount. So how do you then recognize this in the books, this 2 million? What will be the double entry for this 2 million? It is an expense. So by the time you debit impairment loss, you take it to POL and you simply credit assets. Note that if the asset is carried or is measured using a revaluation model. If the asset is measured using a revaluation model, the impairment loss will be treated in a similar manner, in a similar way to revaluation deficits. That is, it will be charged to to profit or loss. Let me see, to be charged to other comprehensive income, OCI, to the extent of any previous revaluation surplus and any extra loss can then be recognized to profit or loss. So what we are saying here is this. Imagine this one that we had 2 million as impairment loss. It was easy. We debited P&L, we credited assets. Fantastic. However, if these assets were to be a revalued asset or an asset that is measured using revaluation model, in this case, we're going to treat this impairment loss in a similar way to revaluation deficit, in that if there was any previous revaluation surplus, revaluation surplus are usually transferred to OCI, right? So if there is any previous revaluation surplus on these same assets, we will need to, first of all, take that loss to OCI. So we're going to charge it to be charged to OCI to the extent of any previous revaluation surplus. And any extra loss can then be recognized to P&L. So what I'm saying here is this. If we had, let's say, a previous revaluation surplus from this scenario of, let's say, 1.5 million, like maybe in the last year, there was a revaluation surplus of 1.5 million. It means that this 2 million, 1.5 million will first of all go to OCI to net off that previous revaluation surplus. So it will be debited to OCI, 1.5 million. So it is any extra 500K that can then go to P&L as an expense. That's the treatment of revaluation deficits. Okay, that's that for that. Do we have any questions before we start solving questions?
Hello, sir.
Sir, please just pick it up. Pick it up for now.
Good afternoon, sir.
Hi, your mommy.
Yeah, please, I didn't get the explanation around this carrying amount. The explanation you just did now, I'm kind of lost. So I don't know if you can re-explain, or if when we solve a question, if that would explain it better. You know.
Is it the previous, when there is a previous surplus?
Yes.
Is it that one?
Yes, when you started explaining this using revaluation model and all that.
Okay, it means that you have forgotten your IAS studies, IAS 16, right?
Maybe.
You have. So I think we would have to look for time. I'll have to teach you guys that again, because it's something you need to know. Even though we are not even supposed to do it, is assumed that for you to be here is either you're coming from FR or you know these things very well, this particular one. So I know that a lot of you might have forgotten. So we'll have to look for time to do IS 16, IS 38, and all of those other standards that we're not supposed to even touch at all. So I'll just look at it. So, which is the principle here? So usually, the way we deal with evaluation deficits is we usually take it to P&L provided we don't have any previous surplus. Like this 2 million loss that we had now, we will just take it to P&L as an expense. We'll just take it to P&L as an expense. But if for whatever reason, they told us that in previous year, we have a previous surplus. We have a previous surplus of, let's say, 1.5 million. For that reason, you need to go and net off. You have to net off that surplus first before you would recognize any balance to P or L. So if the previous surplus is 1.5 million, for example, you see this 2 million would go to OCI. You're going to debit OCI first. And any excess of 500 can now go to P or L. So if you don't understand that, so that it means that we will need to revise IAS 16 so that, because that's where we can have opportunity to explain this better. Okay, any other question? Okay, can somebody read this question for us? Let's start solving questions.
Okay, I'll read. A company has a machine in its statement of financial position at a carrying amount of 150,000 naira. The machine is used to manufacture the company's best-selling product range, but the entry of a new competitor to the market has severely affected sales. As a result, the company believes that the future sales of the product over the next 3 years will be only 75,000 naira, 50,000 naira, and 25,000 naira. The assets will then be sold for that's income. Okay, for an offer. Okay, an offer has been received to buy the machine immediately for 120,000 naira, but the company would have to pay shipping costs of 2,500 naira. The risk-free market rate of interest is 10%. An impairment review confirms that the asset might have been impaired, determining the impairment loss.
So how do we determine the impairment loss here? So when we have the carrying amount, they give us the carrying amount as how much? As 150,000. We'll simply compare this with the recoverable amount, which is the higher between net realizable value and what? Value in use. So net realizable value first is the fair value of selling price minus cost of disposal. So what's the selling price? They give us to say that as a result of the company believes that the future sales of the product over the next 3 years will be only 75, 50, and 25. The asset would then be sold for, so something is omitted here. Let's say the asset would then be sold for, let's say 5,000. So they now said an offer has been received to buy the machine immediately for 120,000. Okay, which is the selling price, but shipping cost is 2,500. Shipping cost is 2,500. So that means the net realizable value is how much? 117,500. Then that's my net realizable value. My value in use is, I'll have my year, then the cash flows, then the discount factor at 10%, then the present value. So value in use is getting the present value of future cash flows. So here now, in year one, my cash flow is how much? 75,000. That's my outflow. Who can get me the discount factor at 10% year one?
0.909.
0.909. So what's the PV?
68175.
68175. Year two, 50,000. What's the discount factor?
0.826.
What's the present value?
41,300.
41,300. Year three, cash flow is 25,000. What's the discount?
0.751.
What's the present value?
18775.
Now, they said they will eventually sell it for how much? 5,000, which is still in year three.
Yes.
So what's the present value of that?
3755.
So what are we looking at as the value in use? We'll add everything together.
One three two double 132,005 naira.
Sorry?
132,005 naira.
Like this.
Yes, sir.
So the recoverable amount is how much? How much is the recoverable amount?
It's
132,
132,500.
500,
Sorry, it's 132,005 naira.
Okay. So how much is the impairment loss? How much is the impairment loss?
17,995 naira.
Which is 150,000 minus 132,005. Who can tell me the journal entry for this? What's the journal entry for the impairment loss? Let me allow Omoumi. Can Omoumi tell me the journal entry for this? Okay, Emmanuel, I can see your hand. Go ahead.
Okay, for me, you debit impairment loss in the P&L, then you credit the assets with the 17,995 naira.
Thank you very much, Emmanuel. You credit the assets. Okay. So don't go, Emmanuel. So assuming assuming there was a revaluation surplus in the last year of 8,500. Okay, so what would be the journal entry?
Okay, for me, the journal entry to be passed will be that from 17,995 in payment loss, you debit the revaluation surplus with 85, credits. I'm coming. I'm coming.
Okay.
Then you credit the value of the assets.
With how much?
You credit the asset with 85. You credit the asset with 85. Then the balance from the 17,995 minus the 85. The balance, what's the balance? Sorry, let me calculate that. 17,995 minus 85. Hold on, please. 17,995 minus 85.
9495.
That is
9495. 9495.
So that 9495, you debit impairment loss in the P&L, then you credit the value of the asset with the 9495.
You debit impairment loss in P&L.
Yeah, with 9495.
9495.
Then you credit the assets with 9495. Sorry, I skipped a bit earlier.
It's not correct, sir. It's not correct.
I think you have to debit the OCI, then credit the assets.
Yes, now
Okay.
this revaluation surplus a debited here is OCI. Because revaluation surplus can only be in OCI, at least for the most part of it. So this is correct. This is correct. So instead of separating this, combine it.
Okay. Okay.
So you're correct.
Praise the Lord.
Hallelujah. So this was what Omomi did not understand. And I was asking her a question now. She did not say anything.
Hello, sir. So sorry, I stepped out briefly.
Okay. How can you be
So
stepping
I
out
didn't know
when
you
you're in
asked the
class?
question. Sorry?
Sir,
How can
please,
you be
can you
stepping
scroll
out
up,
when you're in
a
class?
bit?
I have to use the restroom now.
If you carry your laptop to the restroom. Okay. So there are a lot of questions of this nature. So I don't want to overflog it. A lot. There was one they asked. Let's just look at this together. Before I move to something else. In fact, there was a diet. There was a diet. I can't remember the diet, but you can actually check it out. So this it was like this. They wanted you to calculate impairment loss. So the examiner gave you, of course, the carrying amount, they will give you that one. The net realizable value, they will give you fair value and cost to sell. So just make sure you're able to do the nets to get your net realizable value. Now, the technicality was that for the value in use, they gave you future cash flows for year 1, year 2, year 3, year 4, year 5. But those cash flows that they gave you a cash flow, and they now gave you another future cash flow. They now say that one is net of tax. So they gave you a cash flow that is not net of tax. They now gave you another cash flow that is net of tax, meaning that after removing tax. The same thing for the discount factor. They gave you all these discount factor, net of tax, and the one that is not net of tax. So, I mean, the key question is, which one are you going to use? Is it the one before deducting tax or the one after deducting tax? So the answer should be using net cash flow after you have deducted all expenses, including tax. So this idea of future cash flows is the net after you have deducted everything. And that was it for that diet. So if you understand that the future cash flows you use are the net cash flows after you have deducted all possible outflows. The same thing for the discount factor as well. Now, let's solve this past question. It was in 2018. Can somebody read, please?
Artigen Manufacturing Limited bought a new machine for the factory in Ota, Ogun State for 140 million naira on January 1, 2015. At acquisition, the machine was estimated to have a lifespan of 7 years with no scrap value. The carrying amount at December 31st, 2017 is 80 million naira. The machine generates largely independent cash flows and therefore is tested for impairment as a standalone asset. Due to a downturn in the economy and reduction as well as cancellation of major customer orders due to changes in the marketplace, the directors concluded that the machine may be impaired. You are provided with the following information. Fair value of the machine, 60 million naira. Selling cost is 5% of the fair value. And value in use based on the discounted future cash flow is 63.5 million. Required A. Determine if the machine is impaired based on the above information. B. Calculate, if any, the impairment charge the directors should take to profit or loss.
You would agree with me that this is a very simple question. You would agree with me that. So if you look at how do you solve this question, the solution, the A part is saying that determine if the machine is impaired. So nobody is asking you to calculate it. They just say that you should determine it. So all the examiner wants you to put here is the principle for impairment. So you need to tell them the principle that the machine will be impaired or will be prescribed as impaired where the carrying amount is higher than its recoverable amount, and the recoverable amount is the higher between the value in use and net realizable value. Okay, so you have stated the principle first. You can then tell them that from the question, the recoverable amount, who can tell me what's the recoverable amount here? Is 63.5 million, being the higher between let me say that the recoverable amount is the value in use of 63.5 million because it is higher than the what? Than the net realizable
Net
value.
realizable value.
Okay. So, and since the carrying amount is lower, oh no, since the carrying amount is higher than the recoverable amount,
Hello, sir.
yes,
How did you know that the carrying amount, the value in use is higher than the net realizable value? We've not calculated now.
how won't we know now? Look at it now. It's so obvious that you don't even need to calculate it. From the selling price alone, 60 million, before even removing this, you already know that 3.5 million will be higher than that. There is no even need to do calculation. And this question, you have to be careful because nobody's asking you to calculate anything. It's the B part they ask you to calculate. So, because they look very similar. So you just need to determine and explain to the examiner the principle and some few figures. It is in the B part you now go into every calculation. But there are some things that are very obvious now. This one, you're still going to deduct 5% from this 62. And this 3.5 is already higher than, so it's clear that it is higher. So since the carrying amount is higher than the recoverable amount of 3.5%, the machine is therefore said to be impaired. So they didn't ask me to calculate impairment loss. They just say determine whether if the machine is impaired based on the above information. Yes, it is impaired. Now, the B part is where they say calculate. I can now calculate. I can say my carrying amount is 80 million. My recoverable amount is, I'll get my net realizable value. Being the selling price, how much is the selling price? 60 million minus the selling cost. What is 5% of 60 million? 10% is 6, 5%
3
should be
million.
3 million. So what was the balance?
57.
57 million.
That's 57. Then, how much is my value in use? This is 3.5, abi?
3.5.
Okay, so my recoverable amount is the what? Is the 63.5. So how much is my impairment loss? Impairment loss that will go to POL. How much is that?
16.5.
16.5. Okay. But they don't have simple questions like this anymore. Not that those ones too are not simple, but they always want you to discuss now. You need to, at a very high level, show understanding. This one is too easy. Okay, so that's that for this one. Do we have any question, observations like that? Okay, so let's move to the next level of all this. Now, there's something we call cash generating units. Cash generating units. Cash generating unit. Okay, Emmanuel, you have your hands up.
Sorry, I came late into the class.
Okay.
What topic is this, please?
Impairment.
Oh, okay. Thank you.
And Emmanuel, what do you mean you came late? You answered one of my questions when I started.
Yes, I did. This was residual knowledge, not.
Okay. No problem. So we're doing IAS 36, impairment of assets.
Okay, sir.
Okay. So let's look at cash generating units. Now, why are we talking about cash generating units? Before I give you that, you see, IAS 36 states that a CGU is the smallest identifiable group of assets that can generate cash flows largely independent of other assets. Says CGU, or cash generating unit, is the smallest identifiable group of assets that can generate cash flows largely independent of other assets. So why are we talking about that under IAS 36? So there are some assets that it will be difficult for us to determine their recoverable amount individually. That is not just possible, because those assets individually don't generate cash flows on their own. So it will be difficult for us to calculate impairment loss on them because we cannot determine their recoverable amounts, especially their value in use. And there are a lot of assets like that, like your furniture and fittings, for example, or your computer equipment, or your air conditioner. They are assets, not that they don't impair. If one of them should get damaged, it's difficult for you to get their recoverable amount and therefore impair them, because you cannot get value in use for laptop, for example. Because how can you estimate how much money you make from a laptop, or a furniture in the office, or air conditioner in the office? These assets individually don't generate cash flows on their own. So because of that, we cannot determine their value in use. And that is why IAS 36 introduced cash generating units, that there are some assets we know that we cannot determine their recoverable amount individually. Then we can group them together. That instead of looking at furniture and fittings, air conditioner, and all of that individually, why not just take the whole building, for example, and see the whole building as a CGU? Okay, if it is by considering the entire building that you can know how much they make altogether. So for the purposes of determining impairment loss or specifically value in use, then CGU is very, very important. So CGU helps to determine value in use where we have assets that we cannot determine their value in use individually because they don't generate cash flows on their own. So as far as IAS 36 is concerned, that is the major reason why we have CGU. So with CGU, we group them together. And you will see ICANN in your exam seeing CGU as a business, right? Like when I start teaching you consolidated account, we can see a subsidiary as a CGU. We can see a whole business as a CGU because it actually fits into this definition. Smallest identifiable group of assets that generate cash flows largely independent of other assets. So that means beyond just looking at CGU being helpful for determining value in use of group of assets, that means you can determine impairment loss for a business as a whole with the help of CGU. So you will see the entire business as a CGU, right? So there was a scenario one diet that the examiner told you that there is a company that have chain of supermarkets. It has branches of supermarkets here and there. And they said all these branches, that it is the central head office that buys all the goods and send it to all of them to sell. And also payment of salaries and all of that is actually centralized. The key question was that are all these branches of these supermarkets, are they CGU? Yes, of course they are CGU because each of the branches we can sit down and say this is how much we have made from this branch today or this month or this year. And that's the whole idea of CGU, a group of assets that can generate cash flows largely independent of other assets, that makes money, that you can say, okay, how much did you make today? And you can say, yes, I made 2 million. I made 5 million. That is a CGU. Whether the group of assets, that is a business, and of course, a business will have been a group of assets anyways. So that's the whole idea of CGU. And what he wants to help us to do is very subtle and straightforward. We are having this group of assets because it helps us determine value in use. As soon as it does that, then we can go ahead and determine impairment loss because each of those assets would have their book value anyway. We can easily determine their book value. They will have their carrying amount. Then we can then compare carrying amount with our value in use or recoverable amount. Then we get impairment loss. Okay? Then we have solved the first challenge. I will show you the second challenge with a question because it will be clearer like that. If you look at this question, it says that a cash generating unit, look at it, they're very clear. A CGU comprises the following. So they give us all these assets. They now say that following a recession, an impairment review has estimated the recoverable amount of the CGU to be 25 million. How do we allocate the impairment loss? Okay, this is exactly where I'm going. Allocation of impairment loss. So just hold on and see. So we already have the carrying amount of this CGU as 33 million. As 33 million. And we also now have the recoverable amounts. So I'm assuming that because the question gave me following the recession, the payment has estimated, okay, recoverable amount. So they gave me recoverable amounts as 25 million for the entire asset. So with this now, I can get impairment loss of all the assets for 8 million. So I've gotten my impairment loss. Then the second thing is this, how do you then do the allocation of the impairment loss, which is what the question wants itself? Okay, before I do that, let me attend to Emmanuel. Emmanuel, I'm with you.
Okay, sir. My question revolve around the carrying amounts. You know, the total of 33 million includes current asset amount of 10 million. So I was wondering how how carrying amount value involved bringing in current assets.
Oh, okay, good. So, yes, that's very logical, but we have to include it because this 25 million, okay, has actually considered the entire unit, is the recoverable amount of everything.
Okay.
So if you now exclude it from here, that would, our answer will not be right because we will not be comparing like with like. So we have to
Okay.
include it. Yes. So 8 million. Now, so this 8 million now, you already know that first leg go to P&L, second leg will go to assets. You debit P&L, you credit assets. So this 8 million to assets is not a challenge because we can just take it to assets. Sorry, we can just take it to P&L directly. Now, where we are going to have challenges is the asset part. How are we going to share these assets? So, like I was saying, now the assets, how do we impact these impairment losses on each of these assets? So, IAS 36 has actually given us the order of allocation. So let me just note it here. So the order of allocation of an impairment loss on a CGU is as follows. Number one, to a physically damaged assets. Number two, to goodwill. Okay. Number three, to other assets on a pro rata to other assets on a pro rata basis or on a proportionate basis. On a pro rata basis or on a proportionate basis. So this is how you allocate the impairment loss. Now, when you look at this question, they didn't tell us that we have any physically damaged assets. So there is no physically damaged assets, but there is goodwill. So we have goodwill. Then we can allocate goodwill. Then whatever is remaining, we then give it to other assets. Let me show you. So we want to allocate impairment loss. So the assets, the carrying amounts, the impairment loss, the new carrying amounts. So we have building, we have plants and equipment, we have goodwill, we have current assets. How much was the building? 15. How much was the plant and equipment? 3. How much is the goodwill? 10. Goodwill is 5 here. And how much is this one? 10. So we said first, you allocate goodwill. Since goodwill is 5, and we have impairment loss of 8, then we'll take it to goodwill. Then the remaining 3. So the remaining 3 million will be allocated on a proportionate basis. Proportionate basis. And how do we do that? The building will take a proportion. The plants and equipment will take a proportion. The only one we won't apportion to is current assets, because current asset is not PPE, tangible is not intangible. It doesn't fall within this scope here. It doesn't fall within the scope here, so we will not include it. So here now, the remaining assets, building will take, what's the value of building? 15 divided by the addition of this building and plants, which is 18, multiplied by the remaining impairments. The same thing for these two. It will be 3/18 multiplied by this 3 million. So can you give me the figure, please?
15/18
Come on,
times
sir.
3 is
Sorry, 2,499,999. The first one. The building, sir. Say 2.5 million, sir. Approximately 2.5. Okay.
Okay, so we have 2.5 and we have 0.5.
Yes.
Okay, so building
So
will
you're
take
correct, sir.
2.5, plant will take 0.5. So what's the new carrying amount here? This is 12.5. This is 2.5. This is 0. Why this remains 10? If I add this new carrying amount together, it should give me that recoverable amount of 25.
25.
Yeah. I feel this one is very easy. Let's solve a more complex question. Let's solve a more complex question.
Hello,
Can
sir.
somebody? Yes.
we are still writing that, please.
Oh, okay, sorry.
Hello, sir.
Yes, Ahmed.
Sir, with this question, I'm somehow confused.
Okay.
The point of my confusion is in the beginning, we relate that impairment only relate with non-current assets. But this SUG, this aspect, it includes current assets, which my colleagues pointed out. But by the time I now see allocating the impairment loss, we exclude it. It's somehow to me, it's not that, because in the first place, you're supposed to exclude it before we start. Since it is current asset, that is, it can be, the cash can be exchanged or whatsoever, and the condition at which make these assets to qualify for the impairment is as a result of a recession. Can it still affect the current asset? So I'm a little bit confused there, because to me it's not somehow in tandem with the principle of accounts. Stand to be corrected, sir.
Okay, thank you for your question. So, like we mentioned, like you also mentioned, that we excluded it, and you should always exclude most current asset because it's scoped out of IAS 36. Not that this don't impair. Of course, your current assets also impair too. Like your current asset could be trade receivables, it could be inventory. Of course, they do impair. Just that for trade receivables, for example, now that one is covered under IFRS 9. Like inventory, for example, now that one is covered under IAS 2. Of course, they do impair, but for IAS 36 here, make sure you ignore them. Do not impair them. And so you're also talking about why didn't we exclude it from day one? I think Emmanuel or somebody asked already, and I've already explained that this 25 million they give is like giving us the entire value of the business, 25 million. So in determining the impairment loss, we need to compare like with like. That was why we picked the entire 33. So that's by not allocating 10 million to current assets. It means that current asset did not impair. It's still 10 million. So that means out of this 25, so 10 relates to current assets, while the others are the other figures. And this is how you should approach it in your exams. Don't go and deduct it first. However, like you will see today, as we proceed, when we solve more complex questions, you see that the examiner can specifically tell you that a current asset has been impaired. So when the examiner tells you that specifically, in that case, you then consider it, which you are going to see very soon. But other than that, make sure you completely ignore it when you are allocating and keep it that simple. I mean, it helps.
Thank you, sir.
You're welcome.
Hello, sir. So if we want to do the journal entry now, like this, with debit asset 2.5, building 2.5, PP 0.5, goodwill 5, right?
No. You're not debiting. No.
Credit.
You credit though.
Credit.
Yes. So it's like you're going to debit POL with impairment loss of how much? 8 million. Then you credit building with 2.5 million, credits, plants, and equipment with 0.5 million, credit goodwill with 5 million, like that. So that's what we're saying. Okay, let's take further questions, please. Yeah, Christopher.
No, at the beginning of introduction, of allocation of impairment loss, you make three conditions that can subject for CG to be allocated if they are impaired. And we said the more the asset must be physically damaged and there must be goodwill and other asset on pro rata basis. Then the cost of our work is after getting that of goodwill, you proportionate your basis of allocation. I want to know why you proportionate why not pro rata. And the other thing again is that if for an instance, you find out that none of all those assets are there. Maybe building is goodwill is not there. Maybe it's under asset. Or maybe the imputed maybe furniture and fittings is there. What do we do? What do we do in that basis?
Okay, so this one that I gave you here is not conditions for allocating. It's not a condition. It is the order of allocation, meaning which assets are you going to allocate impairment to first, which is second, which is third. Is order of allocation. So we are saying that whenever you have a CGU and you have an impairment loss on that CGU, you should allocate impairment loss to a physically damaged asset first. After you have allocated to that, if you still have any impairment loss remaining, you allocate that to goodwill. Then you can then allocate to other assets on a pro rata basis. So let me clear that first. And secondly, you are saying, why did we proportionate? Why do you need to do pro rata basis? It's the same thing, pro rata proportionate. It's the same. That's the meaning, like proportionate, based on their relative value. Based on their relative value, which is what we did here. For building, you will see we did 15/18 multiplied by the remaining 3 million. The first thing was for us to allocate to goodwill. So out of the 8 million loss, impairment loss, we gave goodwill first because it's coming here first. Because we don't have any physically damaged assets in this question. So we prioritized goodwill. So we gave it everything. Do you know that if goodwill were, for example, 10, we will have given goodwill the entire 8, which means that the other assets were not impaired. That's what it means.
And
But
it
in this,
ends there.
yes, and it ends there. And it ends there. But in this case now, since we still have additional 3, that means we can then go to level 3, which is to other assets on a pro rata basis. And when we say pro rata basis, we will look at the carrying amount and do like a ratio. Since it's just 2 assets we are considering, so it's like 15/3, which is like
Yes.
15/18 times 3. This one, 3/18 times 3 to get each of their values. Then with that, we're able to get these impairment losses that we give to each of them. Sure you get. And your third
Yes, I
question,
get
you
it.
were talking about if they are not there, they will be there, they'll always be there. So it's not, this thing is very direct. There won't be anything out of the ordinary. It will be clear when they say there's an impairment loss. So why would they now give you something that is not there? Yeah, everything will be visible. So I think we should solve a more robust correction, and you will see that there won't be any twisted anything whatsoever.
Okay.
Okay. So
Thank
let's
you.
have another question, please. Augusta, I saw Ufoma, you're between raising up and raising down, but I mean, Augusta, you can go ahead with your question.
Can you hear me, sir?
Yes, I can hear you now.
Okay, please, I just want a clarification concerning that impairment loss. The goodwill, is it in respect to whatever the carrying amount is that will give to the impairment loss? That's the exact figure, because you were saying you just wrote like 5 million, then the impairment loss is 5 million. So is it in respect to whatever the carrying amount is that will give to impairment?
Yes. Yes. So which is why I restricted it to 5 here, because the carrying amount was 5. And when I was responding to Christopher, I said, even if this one were to be 10, which means that you can swallow the entire 8, we'll have given it the entire 8, and everything ends there. Okay, so
Okay,
yeah,
sir.
it is with respect to it.
Okay.
Okay,
Sorry, sir.
thank you.
Sorry for taking you back. Does it have effect on our workings? If we have 8 as goodwill, 10 as goodwill, and you're able to swallow that 8, the extra 2, does it have anything that we have to do anything with it?
Yeah, so that becomes the new carrying amount. So the 2 will be the new carrying amount.
Okay.
Yeah. Any further questions? Okay. So let's solve a more robust question that will expose you to other things. Can somebody read this for us, please?
As a result of privatization and commercialization exercise currently going on in the country, the Ministry of Transport sold the assets and liabilities of the newly constructed standard gauge railway to a private company known as Starlos Rail Limited (SRL) to ensure smooth operations of the railway services by freeing it from government bureaucracy. The summarized extract of the Statement of Financial Position at fair value of SRL on January 1, 2019, reflecting the terms and conditions of the sales agreement of the Transport Ministry are as follows. Assets: goodwill 150 million naira, or rather 150 billion naira. Operating license 900 billion naira. Property: train stations and land 225 billion naira. Rail tracks and coaches 225 billion naira. 2 train engines 750 billion naira. Purchase consideration 2,250 billion naira. Sundry liabilities nil. The operating license is for a 10-year period, which was issued on January 1, 2019 by the Transport Ministry, and it is stated at cost. The carrying value of the property and rail track and coaches are based on value in use. The engines are valued at their net selling prices. On February 1, 2019, one of the train engines got damaged due to a technical fault from the manufacturer, and the engine was completely destroyed. The sale of the assets to SRL was without recourse to the Transport Ministry and the manufacturer of the engines. In view of this, it was estimated that there would be reduced passenger capacity. Therefore, the estimated value in use of the whole train service business of SRL was assessed at 1.5 billion. The number of passengers after 1 year The number of passengers after one of the engines of the train got damaged was below expectation, even allowing for the reduced capacity. In the light of this, the value in use of SRL rail services was reassessed on March 31, 2019 at 1,350 billion naira. On this date, the SRL received an offer of 675 billion naira from another company called Papaya Railway Services Limited (PRSL) for the operating license since it is transferable. The realizable value of the other asset has not changed significantly. Required: A. Draft a memo addressed to the MD of Starlos Rail Limited, explaining the basis of allocating an impairment loss to the assets of a cash generating unit in accordance with IAS 36 on impairment assets. B. Calculate the carrying amount of the assets of SRL Limited as at February 1, 2019 and March 1, 2019. C. Explain two conditions that must exist before an impairment loss can be reversed.
Okay, thank you very much. Now, if you look at this question, we're asked to draft a memo addressed to the MD of Stalos explaining the basis of allocating impairment loss to the asset of a CGU in accordance with IAS 36. To answer this, I don't even need to read the question. You can just go ahead and answer this one. So, let's assume I'm the accountant. So, let's say I'm the MD. What's the date here? Let's say February 2019. The subject, allocation, basis of allocation of impairment loss to a what? To assets, to the assets in a cash generating unit. Okay. So the subject matter refers following paragraphs explains the basis of allocation of impairment loss to the assets of a cash generating unit. Number one, to a physically damaged assets. Number two, to goodwill. Number three, to other assets on a pro rata basis. Note that if there are current assets within the CGU, this should be ignored unless it is specifically clear that the items of the current assets give rise to the impairment loss. So, should you require further clarifications, do not hesitate to revert. Thank you.
That is all.
Yes, sir. That's all for that. So that's the A part. The B part says that calculate the carrying amount of the asset of SRL as at February 1st and March 1st, 2019. Okay. So let's look at this question. They want us to calculate the carrying amount as at February 1st and March 1st. Okay. So what is this first paragraph talking about? They said as a result of privatization and commercialization currently going on in the country, the Ministry of Transport sold the assets and liabilities of a railway to this company, okay, to ensure smooth operations. They fine. So, second paragraph, they give us the balance sheet of this company, okay, which is these assets and liabilities, okay. So these are their carrying amount, okay. So we're now told that the operating license is 10 years, and they got the license on January 1st, 2019 by the Transport Ministry, and it is stated at cost. We were also told that the carrying amount of the property and road tracks are based on their value in use, and the engines are valued at their net selling prices. Okay, so this is very important because they are telling us that, okay, this is the cost of the operating license. These two, they are value in use, and these two train engines, that this 750 is their selling price. That's their net realizable value. Okay. Now, on 1st February 2019, okay, we're told that one of the train engine got damaged due to a technical fault from the manufacturer, and the engine was completely destroyed. So the sale of the asset to SRL was without recourse to the Transport Ministry, meaning that this company cannot go back to the Transport Ministry and say that the train you sold to me, engine have damaged, they'll give me back my money or incur some of the expenses. No, it cannot happen because the sale is without recourse to the Transport Ministry. Okay. We're now told that in view of this phrase, it means that in view of the damage, something like that, it was estimated that there would be reduced passenger capacity. Therefore, the estimated value in use of the old train service business is now 1.5 billion. Okay, so they are giving me the value in use of the business. So that means they are seeing the business as a CGU. When they give you the value in use of a business, that means they are seeing it as a CGU, and it's 1.5 billion. Okay, and all these in February. Okay, so the last paragraph, they said the number of passengers after one of the engines of the train got damaged was below expectation, even allowing for reduced capacity. In the light of this, the value in use of the SRL's rail service was reassessed in March to this. So it reduced further again. So he now said on this date, the guy received an offer. So my guy is already tired, he probably wants to sell. So he received an offer for the license. So from another company called Papaya. And the guy says he's going to buy it for 675. And the realizable value of other assets has not. Okay, good. So quite a number of details, but I mean, the question is saying you should calculate carrying amount. So I'm just looking at a lot of students will not even know the first step to do here. Okay, carrying amount. How do I do carrying amount here? You should know that carrying amount is cost minus accumulated depreciation minus impairment losses, right? But in this case now, these figures given to us has already factored in impairments. Why some, I said impairment, depreciation, why most of them will not be depreciated because of what their values are. Like this is net realizable value, this value in use, and all of that. So the only thing you need to deduct from these figures is the impairment loss so that you can get the new carrying amounts. So you will need to then determine the impairment loss. Good enough for you. The examiner actually gave you on February 1st, 2019, because of the damage, they gave you the recoverable amount or the value in use of the old train service. So it then becomes easy for you to determine the impairment loss at that date, because you can just compare this with the addition of all these assets, which is this that will represent the carrying amount. The difference is your impairment loss. However, that impairment loss belongs to these individual assets. That means you then need to allocate. So I think we should start with that first before we go to March. So let's sort out February. So the B part of this question. So we need to determine the carrying amount on February 1st, 2019. So what are the assets given? Their relative values, the impairment loss, then the new carrying amount. So what are the assets here? Let me just copy it. Okay, so the total from up there, let's say that's the global carrying amount of the business. It was 2250. And we're given the recoverable amount as the value in use of, what's the difference between these two? What's the difference? Because that would be our impairment loss.
750,000, sir.
That's 750,000. So now this 750,000, we need to share it between these assets. But one thing I need to bring your attention to is this value in use that I used here. Ordinarily, impairment loss should be recoverable amounts compared with carrying amount. Why am I using only value in use? Because you are not given the realizable value of the entire business. The question only gives us the value in use. So we use the value in use as the recoverable amount. Okay. So based on this order of allocation that we have here, that means we need to allocate first to a physically damaged assets. Which of these assets was physically damaged as at February 1st, 2019? We were told that on February, one of the train engine got damaged. Okay. And we have two train engines. So if two train engines is 750, how much is one?
75.
275.
So 375,000. That's one. Is there any other damage to an engine? No, it's just this one. Then the next will be to goodwill. The next will be to goodwill. So out of 750, we have allocated 375. I think we still have enough. So we can also give to goodwill to the extent of the goodwill. So give it everything because we have more than enough. So how much impairment loss do you have left? What's the balance of impairment loss?
225. 225.
Okay, after allocating to damaged train engine, and goodwill is, you said 225, Abby? Okay.
Yes, sir.
So this balance should be allocated on a what?
Pro rata basis.
Pro rata basis. So what are the assets in question? Operating license,
Let's see.
the
Train station and land.
What again?
Rail track and coaches.
Aerial tracks and coaches. What again?
One of the two train engine.
Okay, one of the or remaining train engine. Okay, now I need you to note something. Note that we cannot allocate further impairment to the remaining one train engine because it is valued at its net selling prices or NRV. And since the objective of impairment loss is to present the realistic value of an asset, which is either its NRV or value in use. So it will then be an undervaluation to impair any assets below this limit. So I'm just trying to remind you the objective of impairment loss is to present the realistic value of an asset, which is either its NRV or VIU, either of the two. So since if you look at this question here, they already told us that the engines are valued at their net selling prices. So that means these engines are already presented at their realistic value. So we cannot impair it below this level. If you take it below this level, then it becomes an undervaluation. So since they're already valued at their net realizable value, so you leave them. That is where we want them to be. Okay. So for that reason, this will not be included in so that's why I note this one for you here. Note that we cannot allocate further impairment loss to the remaining one train engine because it is valued at its net selling price on NRV. Remember that, remember that the objective of impairment loss is to present the realistic value of an asset, which is either its NRV or so, to then be an undervaluation to impair any asset below this limit. So we will not impair it further. Now, the 225 to the other assets. So the operating license is 900. So can you do 900 plus 225 plus 225? What would that give us?
1,350,000.
So you can note it in your own workings. How we got this. So you should know that is the addition of the ones we want to prorate to, multiply by the 225,000. So what would that give you for this one?
$150, sir. 150,000.
Okay, 150,000. For the train station and land, that would be 225,000 divided by 1,350 multiplied by 225. How much would that give us?
$37,500.
This one will give you the same amount because they are the same figure. Still going to give you 37,500. Okay, so the license 150,000. The property, train stations and land 37,500. The rail tracks and coaches 37,500. So what's the balance? Carrying amount here is 0. Here would be, I think this is 150. What would this give us? Let me confirm that I'm correct too. Yes.
Yeah, it's correct, sir.
Okay, how about the others?
Yes, it's correct.
Okay, good. You know that if you add this together, it should give you that that value in use, that new value that you're writing it down to. Should give you that figure. Okay. Now, we have determined the carrying amount as of February 1st, 2019. Now, let's determine the carrying amount on March 31st, 2019. Okay. So, yeah, Damilola, please ask your
So,
question.
sir, the total is 1,505,000. 1,500,000. 1,500,500. There's
Okay,
500.
I made a mistake here. This is 375,000. Okay, so let's determine the carrying amount as a March, because this question wants us to determine the carrying amount in February and the carrying amount in March. Okay, so March 1st, 2019, where is it? Okay, so I will start working from here, from these figures here. That was what I brought forward here. And from there, we know that the carrying amount was, so what happened in March? So as at the end of that March, they updated the value in use of that train service to 1,350. And they were ready to sell the license. They received an offer for the license of 675. Okay, fine. So that means the value in use now is now 1,350. The value in use is now 1,350. That means we'll have an impairment loss of how much? of 150. So how do we allocate this impairment loss? How do we allocate this impairment loss of 150? So the same way, number one, do we have any physically damaged assets here? No. Okay, we don't have any physically damaged assets. The one train engine that has damaged, we have impaired that one fully in February. So no physically damaged asset. Do we have goodwill? No. It has been impaired fully in February, so we don't have goodwill. And that means that we can then allocate it on a pro rata basis. Okay. So note that these assets will be impaired on a pro rata basis because there is neither a damaged asset nor goodwill as at these dates. However, the assets that were valued at their net selling prices will not suffer further impairment losses. So remember, this train engine is at its net selling prices, so it's not going to suffer any impairment loss. We're not going to allocate anything to it. So the value remains 375. It cannot impair below that point. Otherwise, you'll be undervaluing the assets. Additionally, this operating license, they already told us the net selling price as well. They said the net selling price is now 675 from the question, because they said somebody they bought an offer to buy it for 675 billion. So as a result of that, we know the net selling price now. So knowing that then means we can determine the new carrying amounts, the new realistic value, which is 675 as against 750, which automatically means that this operating license has been impaired by 75. Because if you do 750 minus 675, it gives you 75. Now, the remaining two assets will be impaired the remaining impairment loss of 75,000 will be allocated to the two assets on a pro rata basis as below. We have the rail tracks, and we also have the train station. So that will be 187,500. What's the addition of the two?
375,000.
Multiply by what? 75,000. What does that give us? Without even you giving me figures, I can guess what the answer would be, because like I'm sharing this into two since they have equal amount. So that's 7,500. This will bring it down to 150. 15. If I add this together, I should come to that 350. 350,000. And that's the end of this question. At least this B part. So I believe this question should expose you to some other areas, even though we are still saying the same thing, but I mean in a more elaborate manner. And the very key things here are the fact that they are bringing in net realizable value of each of those assets. And the examiner presumes that you understand the fact that you cannot impair these ones further because they have already given us their net realizable value. And interestingly, they even give us one, they give us its net realizable value, different from what the value was before. So you need to know that the new value should be the net realizable value, and the difference, that means the reduction is now the impairment loss you're allocating to that, while the remaining you can then do it on a pro rata basis. Okay, so that's that for that question. And the final thing here was that we should explain two conditions that must exist before an impairment loss can be reversed. So remember I told you that impairment loss is a permanent loss. Impairment is a permanent loss in the value of an asset. So I'm saying that they want two conditions, meaning that it's possible for reversal to happen. Okay, so before you can reverse, two conditions for reversal of an impairment loss. So number one is that there is a positive indicators of impairment resulting in the upward review of the value of the assets. Number two is that the new value of the assets must not be higher than the original value before the impairment loss. So the new value of the assets must not be higher than the original value before the impairment loss. So what we are saying here is this. So is that if you have let's say in 2024, the carrying amount of an asset was 100 million. Okay. So as a result of impairments, the value came to, let's say, 90 million. So in 2025, so there was a reversal, okay, in such a way that the fair value of the asset is now 110. Okay, so what this second point is saying is that whenever there is a reversal, we are saying restricts the upward movement to the original value of the assets, which is 100 million. So the value cannot go beyond this original value before impairment. You cannot say the value is now 110. Yeah, it's fine, but we are going to restrict it to 100 million. So it can only go up from 90 back to 100, not from 90 to 110. No, because impairment is serious. It's when we say impairment, we don't expect you to come back and say the value has gone up. It means there is something wrong somewhere. So we'll rather restrict it to the initial value. And I'm going to give you this one as assignments, right? I'll advise you to try it. And there are a lot of questions on impairments in your past questions, a whole lot. But this one is one of the most difficult of it all. So just try it. Not difficult per se like that. Just look at it and let me see what you can come up with. Then we would progress from here. So technically, we are done with Impairment IAS 36. So the next time we're going to be meeting, I will be delving into IAS 12 on income tax. So we are supposed to do, I've always told you I want us to schedule a Sunday for us to start solving past questions together. Not that we are rushing, I want to quickly finish, but I just want to be sure that you actually know what I'm actually teaching you. So tomorrow now will not be, now is my fault because I had to be somewhere in the morning. So I will not be available tomorrow. But at least make sure you maximize that time to revise, do past corrections, make new discoveries, and all of that. Because the exam is fast approaching, we're already in August. So by the end of August now, the exam is getting closer. That means we have another 2 months of classes, then we'll be done. We are moving at a very good pace. We are moving to IAS 12. When I'm done with IAS 12, I move to IAS 37. When I'm done with IAS 37, I probably would move to maybe IAS 8, then IFRS 15, like that. That sequencing is right that way. So that's in August. First week in September, group accounts. I'll teach you group accounts. Based on my plan, we're going to spend 7 classes for group account. Then we'll go back to these standards because your exam is more of standard. When we are done with that, then we'll look at ratio analysis, EPS, then sustainability reporting framework. That's definitely coming out this diet because it's a new introduction, and that'll be all for the exam. Hopefully, we'll be able to finish this thing early by introducing that Sunday classes. Then that will definitely help you guys ready. So I might be ready. I might be well positioned and have all of these things at the top of my head. But it's going to be defeated if you're not moving at my pace, if you're not studying, if you're not revising, if you're not doing my assignments, which of course from the data I have, most of you don't do the assignments, right? So which is not encouraging, of course, which is not good for you as well. So let's put up the work so that when result comes out, you'll be happy. So I'll stop here for today. We would continue on Wednesday if you don't have any question. So do we have any questions before I go?
Yeah, I have a question, sir.
Okay.
How do we submit the assignments?
Send it to my DM on WhatsApp. You can pick up my number on WhatsApp. I'm the guy that sends the notes, the meeting invite, and all of that.
Oh, okay.
Yeah.
Okay. Thank you, sir.
You're welcome. Bye. See you later.